Yes, dear. Today will be the last lecture for the batch 1224. So good evening, everyone. Let's wait for a few minutes. Let's wait so that others can join as well, and then we will start. So hello guys, let's see some of your doubts. Can you send the yes? Please raise a ticket about it, Asit. I'll make sure that you receive that through mail. Yes. Today will be the last lecture for the batch 1224. For exams, raise a separate ticket. The team will get in touch with you. So allow me a minute. Let me connect my pen tab, and then we will start with the session. Yes, if that is the case, DS, that lecture will be cancelled. I will make sure that it is get done. For 0224, the batch for 0224 started in March, right? So March, April, May, June, July, around August. Last week of August or mid of August, you will be having your last lecture, Rupashi. Yes, today you guys will be having your last lecture, the one who has started their lectures from January. No, for the class which started on 1st Jan. For that class, for 1st Jan means first week of Jan. For those people, it will be their last lecture. Okay. So I hope from now onwards, no one will try to address about lectures. From here onwards, let's start to talk about the topic that we are going to discuss. Okay, just give me a second, guys. So let's start. Shall we start, guys? Perfect. Now, the module name is Asset Management and Mutual Funds. To start with our discussion, I'll come to mutual funds. But before coming to mutual funds, mutual funds is the common word that you might have heard. And the other word, a bit uncommon, is hedge funds. How many of you have heard the word hedge funds? GA has heard it, okay. Batlan sir says he has heard it. SK heard it. BM heard it. Perfect. Now, what is the difference between? I have joined the session yesterday, but bit late after 15 because I was on smart action for me. Guys, again, I am not the one who takes care of the attendance. Please raise a ticket if that is the case. The team will get in touch with you and they will make sure that your attendance are being rectified. So don't worry about the attendance. If you are concerned about your attendance numbers, just make sure you raise a ticket about it and people will get in touch with you with the respective team. Okay. First of all, let us try to understand what are mutual funds. Mutual funds are basically example of pooled products. In fact, both mutual funds and hedge funds are example of pooled products. Now the question is, what happens in a mutual fund? There are many investors who create a pool of funds in a mutual fund company. The mutual fund company appoints the portfolio manager. I am coming to what does pooled products mean. And that mutual fund and portfolio manager invests on behalf of all these investors in the capital markets. Okay. So this portfolio manager carries its expertise and specialization to help these investors generate a good return. Now, what are some of you are asking, what are pooled products? Here, everyone, every single individual came as an investor and invested their amount of money. This money became the pool of funds. So what are pooled products? Pooled products are those products where individual investors come together and create a pool of funds, and those pool of funds are utilized to invest in various avenues. Am I clear with this? Am I clear with this? Now, what? No, we cannot say that. So Batlan sir is saying that can we also say mutual fund is a basket of top performing stocks put together? It's not that. Does every mutual fund gives you a positive return? Does that mean every mutual fund security that the fund manager has selected or the portfolio manager has selected gives you the best performance? The answer is no. So it is not the basket of top performing stocks. Now, why would anyone invest in mutual fund or any of the pooled products? Why would any of the person should invest in mutual funds or pooled products? And you might have heard different campaigns in different countries with respect to mutual funds. Why is government promoting mutual funds so much? Extra income that is also possible through securities, investing in stock, less risk, correct, and less risk due to what? The advantages of mutual fund is professional management of funds, because a fund manager is a professional with lots of years of expertise. Then mutual funds are liquid, so it can easily be converted into cash. Can retail investor can start the SIP with minimum amount? Yes, the minimum amount I guess for SIP is 100 rupees or 500 rupees, something like that. So I guess 100 rupees is the minimum amount through which a retail investor can start his SIP. So liquidity, some mutual funds are highly liquid that can easily be converted into cash. Yes, due to professional management, it saves times of investors as well. So this is for individuals with time constraints. So mutual fund resolve time constraint issue and helps them to get the exposure in equity markets or debt markets, even capital markets. One of the most important benefit is diversification benefit. This is a very important point that I am going to highlight. Just give me a second. Also, transparency is very high in mutual funds, and why transparency needs to be high, that is also something that we will discuss. And finally, mutual fund has low transaction cost. Now, coming to these last 3 points one by one. What is diversification? I am coming to that. Let's say case you want MRF shares. You want to buy MRF shares. What is the minimum amount that you will require to buy MRF shares through equity market? What is the minimum amount that you will require? Around 1 lakh. This is price of MRF shares. Since there is no fractional owning system in India, you will at least have to invest 1 lakh and you will get exposure to only MRF shares. You will get proportionate ownership only in MRF, even after investing 1 lakhs. Instead, if you would have invested in a mutual fund, that mutual funds invests in 100 or let's say 50, that mutual funds invests in 50 companies, that also includes company in tire sector. So 1 lakh invested in these 50 companies, 1 lakh invested in these 50 companies by you will give you exposure to MRF plus 49 other companies. Now, what is diversification? Let's suppose you had 1 lakh shares and you invested that 1 lakh in just one single share. I am coming to that, Soumya. Just give me a minute. If you have 1 lakh and you just invested in that 1 lakh in one single share, then you have made an concentrated investment. On the other hand, if you have divided your capital of 1 lakh and invested in different avenues, let's say 25 different shares, it means that you have made a diversified investment. So basically, what is diversification? Diversification is investing your capital in different resources, in different investment avenues. Okay. Soumya is asking what is time constraint in mutual fund. So Soumya, if you are investing in stock market, you need to analyze which stock you should select. You also need to analyze and monitor those stocks, how they are performing. But if you invest in a mutual fund, a fund manager is been appointed to help you or to do this on behalf of you. So this would be done by fund manager instead of you. So those people who have time constraints, who don't have time to create a portfolio, research about the stocks, mutual funds serves their problem. What mutual fund manager will do? They will invest their money on behalf of them. Okay, so this is how time constraints is resolved in mutual fund. So for what time we can invest? We can invest for any time horizon. There are some open-ended fund and close-ended fund. We are going to that for what is the investment horizon for mutual fund. But like shares, there are few mutual funds that can also be traded. Mutual fund is a type of AMC. Mutual fund is a type of AMC. Similar such AMC is hedge fund. And fund manager works for AMC, right? Now, what is hedge funds? So diversification benefit is there in mutual fund. By investing a small amount, you get an exposure to a variety of securities. Next is transparency. Now, there are ad campaigns running for mutual funds. And the best celebrities of the nation work on that ad campaign. It means that government wants investors to invest in mutual funds. And why so? Because when people will invest in capital markets through mutual funds will buy securities using the pooled product or pool of funds. This pool of funds will be utilized by companies as the resources for their capital. This will improve the flow of capital in the economy. And if people are having more capital, they will be doing more capex, that is capital expenditure, in establishing more property, more plant and more equipments. Have people would be having more employment. More the employment, better the standard of living. That's why a government would want individuals and retail investors to be very specific to participate in capital markets through mutual funds. Now, since government is promoting mutual funds so much, affect these funds, especially events outside the financial paradigm. For example, the Porsche accident case in Mumbai. Well, it depends, RK, whether the Porsche. I will come to that as well. I have noted down your doubt. I will definitely. I'm definitely going to discuss that part as well. Now, since government is promoting mutual funds, since government is referring mutual funds by a slogan says mutual fund is right. In India, there is a campaign which says mutual fund sahi hai. It says mutual fund is right. Mutual fund is a right tool for investment. Individuals investing in mutual funds invest in mutual funds by trusting on government, and also those celebrities who has worked in their ad campaigns. So don't you think government won't let these mutual fund house government won't let these mutual fund houses to do any fraudulent activities with these retail investors? Do you think government will allow these mutual fund houses to do fraudulent activities with retail investors? Definitely no, right? And why so? Because every government want to establish trust of its people in capital markets. Why? Because that would increase capital flow in the economy, that would increase capex, employment, and improve standard of living, and that is what government aim to provide you. That is why mutual fund is a highly regulated business. That is why transparency, it is a need of an hour that transparency of mutual fund should be very high. The second point is very much connected. Let's say if mutual funds has high transaction cost, will anyone be investing in mutual funds? Let's say if you are buying securities worth 100 rupees and 20 rupees is paid by you in transaction cost, will you be investing in mutual funds? The answer is no, because that is straight away 20% decline of your investment. That is why mutual funds are regulated to keep their transaction costs low. On the similar note, there is something called as hedge funds. Hedge funds is the another example of pooled products. The person managing the hedge funds is called general partner or fund manager. Now, what does hedge funds do? Hedge funds, also mutual funds is for common people like you and me, basically retail investors. Now, the purpose of promoting mutual fund is basically stable rate of return to investor and also low risk. Yes, some pension funds do invest in mutual funds. Pension funds are something different. I'll come to that as well, Batman sir. General partner is the person who manages the hedge funds. Hedge funds are for HNIs and ultra HNIs. For every nation, the definition of HNIs is different. HNIs are basically big players in the market, and ultra HNIs are even bigger players. These people are not happy with returns provided by mutual fund. these people, these big players have a better risk appetite. That is, ability to absorb risk is higher risk absorbing capacity. And they are not suffice with the mutual funds return. Being in a way so, that is where hedge funds comes into the picture. Now, where does hedge funds invest? Hedge funds can also invest in equity markets. But along with equity markets, hedge funds will also take a great exposure to derivatives, which is a high risk, high reward instrument if evaluated from a trading point of view. Along with this, hedge funds also invest in private equity. It means that buying shares of private company like Shark Tank. Why hedge fund is a pooled product? Because again, various HNIs will invest in a hedge fund and create a pool of funds. Let's say that pool of funds is 100 million. Now the hedge fund manager will select 10 different companies. Again, this is what I'm explaining. What is hedge fund? Hedge fund is basically mutual fund for high net worth and ultra high net worth individual. Yes, we will be coming to the market cap of the mutual funds as well, one by one. So let's not jump into the concept. Let's cover each and everything in a streamlined manner. Now, yeah, hedge funds come under alternative investment fund. That is correct. And it is one form of asset management companies. Now, 100 million is the pool of assets that is being collected by the general partner or the hedge fund manager. This fund manager will be selecting 10 different companies and investing 10 million each. And after 5 years, after providing strategic assistance to this company, they will sell these companies at a better multiple. That multiple can be 3 times, 4 times, 5 times. Well, it differs from hedge funds to hedge funds, but I guess it is about 7 crores or 8 crores, about 1 million. Different hedge funds might have different ticket size that you can invest in a hedge fund. But generally, what makes hedge fund different from a mutual fund is it is been taken as an investment avenue by high net worth and ultra high net worth individual. Now the question is, the benefit of professional management also comes with hedge fund. Liquidity, will hedge funds be more liquid than mutual funds or less liquid than mutual funds? Well, different companies have different criteria of what they expect as the minimum amount to be invested in hedge funds. And also it depends from company to companies what is the minimum amount as a hedge fund manager takes. That is called the ticket size. So if ticket size is between 20 crores to 30 crores, then the individual belonging in that bracket will only be able to invest in this fund. Okay. Yes, I am coming with similarities. So similarities is basically hedge funds are also types of pooled products. Ticket size is the minimum amount required to invest in a hedge fund. That is threshold limit. The minimum amount required to invest in a hedge fund. If they have kept minimum barrier of 10 crores, someone about 10 crore will only investing about 10 crore will only be able to invest in hedge funds. That is basically ticket size. Now again, hedge funds is an example of pooled product. It is also professionally managed by fund manager. Is hedge fund more liquid than mutual fund? No, it is less liquid than mutual fund. Why? Because always the investor who is investing in hedge fund is an HNI. He is ready to park his money for a longer period of time. But an retail individual investor can be in the need of money anytime. So he wants to redeem. So liquidity in mutual fund is higher. Liquidity in hedge fund is lower. Okay. Next is time constraint resolved. That is again a similarity. A fund manager will be there for you to select the securities. Even in hedge funds, we get diversification benefit. But would there be transparency in hedge funds? The transparency is lesser in hedge funds. Can anyone say why? Can anyone say why the transparency is less in hedge funds? Because it is less regulated. It is what I mean when I say it is less regulated. SEBI is the regulator in India. Securities Exchange Board of India is a regulator of India that regulates Indian capital markets. Will SEBI, according to you, should SEBI work for individual retail investor, or should they interfere in the matters of individual retail investors and protect their rights? Or should they invest? Or should they invest I'll come to that as well. Any example of hedge funds, I'll come to that. Just give me a second. There was a SEBI should intervene among the matters of individual retail investor, or should they intervene on the matters of HNIs? These HNI people are self-capable of managing their finances. They invest in hedge fund to get high risk, to take high risk and get higher reward. High net worth individual. HNI stands for high net worth individual. High risk and high reward. If SEBI interferes in the matter of HNIs as well, then hedge funds would be same as mutual funds. What would be the difference? There won't be any difference. So these hedge funds are less regulated. That is why the hedge performance of hedge funds are less transparent as compared to mutual funds. The transaction cost and management compensation is generally high. Transaction cost and management compensation is generally high in case of hedge funds. In case of hedge funds. Now, someone was asking, what is the example of hedge funds? Well, if you Google, there might be names of many companies that might be registered themselves as hedge funds. But to be very honest, I have never come across any company and try to research about hedge funds, because generally individual investors won't get the opportunity to invest in hedge funds. Berkshire, I don't think so. It is an example. Maybe Berkshire may be an hedge fund. Berkshire by Warren Buffett. No, retail investors cannot invest in hedge funds. Only HNIs can invest in hedge funds. And yes, Aryan is saying that a fund managed by Warren Buffett, that is Berkshire, is a hedge funds. They manage people's money by through hedge funds. Okay. Now, what are different types of mutual funds? As I said, retail investors cannot invest in hedge funds. Only HNIs, someone with a high net worth, can invest in hedge funds. Now, mutual funds can be classified on various types, and there are various bases of classification for mutual funds. So if we want to study mutual funds types, we have to study the basis on which it will be classified. First, by structure. By structure, mutual funds are open-ended funds. Yes, even me. Glad to hear that, Lenovo. So there is a certification by SEBI, that is NISM 5A, which specializes on study of mutual fund. The name of the certification is Mutual Fund Distributor, I guess. NISM 5A and 5B. Yes. As an investor, you will need permissions and most probably qualifications that allow you to manage people's money. NISM 5A and 5B, these are the two levels of mutual fund distribution exam, mutual fund distributor exam organized by NISM, that is a body of educational body of SEBI. By structure, it is open-ended funds. Ashish, even you have done completed that. And may I know the name of the person who has joined from Lenovo laptop? Please change your profile name. Then close-ended funds. So if I am stuck anywhere, please guide me, you guys, those who said that those who have completed mutual funds exam. Yes, mutual funds providers and distributors should be certified with SEBI. Open-ended funds, closed-ended funds, and interval funds. Even Priyanka has completed 5A. Karansha is like highlighting the names, organizational structure, portfolio management, investment objective, portfolio basis. Second is by nature. The second classification is by nature. I am highlighting every fund, every type of fund, and then we will discuss what are the characteristics of each type. It's equity fund, debt fund, balanced fund, then by investment objectives, asset management companies are simply those companies, those are managing people wealth. The companies who are responsible to manage people's wealth are asset management companies. Objectives are growth schemes, basically who invest mostly in equity. Then there are income schemes, which invest in debt funds, balanced scheme, and then short-term money market scheme. And finally, the purpose. And I will club this under the name other schemes. First one is tax saving, where the purpose is to save tax, generally invested in ELSS, equity linked saving schemes. Then index funds. These are meant to replicate the performance of a certain index. And then sector specific funds. Take a minute, read out each and everything that has been mentioned over here and try to get an idea that what this particular fund name implies about the fund. When we will go on discussing the fund, you should try to match what was your idea about the fund and what actually we are discussing about it. Please let me know once you are done with reading all the names at least. If ready, please let me know so that I can start with the explanation of open-ended funds and close-ended funds. VT is done. TB is done. Perfect. DK is done. SK is done. Yes, balanced fund are basically hybrid funds. Balanced fund are also called as hybrid funds. Okay. Shall we start? Okay. Here is open-ended funds. Then here is close-ended funds. Basically, open-ended funds are those funds. Open-ended, the word itself says. The shutter or the counter is always open. The counter is always open. What I mean when I say the counter is always open, I mean that if you want to invest in the fund, you can anytime invest in the fund, invest in the fund anytime and sell the units. So when you invest in the funds, you give money to the fund manager or the mutual fund house, and the mutual fund house gives you back shares, and those shares in terms of mutual funds are typically called units. The shares received for the money that you have invested in a mutual funds are called units. Shares are not the word over here. Units is actually the word, but I just wanted to give you an idea what are units. So units are basically the shares that you get in terms shares that you get when you invest in a mutual fund. What I mean when I say the counter is always open, it means that if you want to invest in this fund, the office of this fund will always be open for you. You can invest, go to the office, counter is open, you can buy that fund If you want to redeem the units, it means that you want to sell the units to the mutual fund and get back your money. That means counter is always open. Counter is always open to buy or sell the shares. In case of close-ended funds, invested, in case of close-ended funds, investor can buy in the funds only during a limited time period. Yes, they can invest directly as well. There is no necessity that you need to follow a broker to invest in a mutual fund. You can directly invest in as well, but going through a broker has an expertise and experience over the years of investing in mutual fund. He can help you select the right mutual fund for you. He can help you select the mutual fund with a low expense ratio, and a broker could hassle free your investment journey. Means all the paperwork he will take care of. You don't have to worry about it. But for that, he takes a certain commission from the mutual fund. Investment. Investor can buy in the fund only during a limited time period, and that period is called new fund offer. Like while investing in an IPO, initial public offering, like investing in an IPO, initial public offering, there is a due date before which you need to submit your application. Similarly, while investing in an NFO, new fund offer, there is a due date. For close-ended funds, you can only invest before the new due date. And over here, you can buy or sell the shares anytime you want. These open-ended funds are not listed. It means that they are not listed in a stock exchange. These are not exchange traded. These are not exchange traded. While close-ended funds are exchange traded. It means that they can be listed or traded in an exchange. So basically, let's suppose Aditya Birla came off with a close-ended fund, and I subscribed to the fund. I got units for what I paid. Now, I won't be able to sell these units. Yes, Ashish, but I won't just want to pop up the name over here. We will come to that as well in the next part. I cannot sell back those shares to Aditya Birla, but I can sell these shares to other participants in the market. I can sell these shares to other participants in the market. Now these shares will be traded among the investors of the market or participants of the market. Aditya Birla Fund has nothing to do with the fund now. The only thing he is responsible is for managing the fund. He has no hassle of managing the investors. That is close-ended fund. Here, if we want to invest in SBI, like through securities, shares, you are talking about. Yes, you can invest. You can open your discount broker app or even go to the SBI mutual funds website, and through there you can invest in mutual funds. Here, pricing is close to NAV, net asset value of the fund. What is net asset value of the fund? Net asset value is basically the consider net asset value as current market price of the fund. we will come to detail what actually NAV is, current market price of the fund. While over here, close-ended funds are traded based on the demand and supply factors. Yes, and you are correct, GA. But I will come to that. Just give me a second. NAV is basically value per unit on a specific day. Yeah, you can say that. Net asset value. So the unit price of the fund can also be greater than NAV. If it is greater than NAV, it is called traded at premium. If it is less than NAV, then it is called traded at discount. So open-ended funds are priced at NAV and close-ended funds are priced during demand and supply factors, maybe at a premium, maybe at a discount. Now before jumping to the next point, let's discuss what NAV is. Very simple. NAV is total assets minus outstanding liabilities upon number of units. That is NAV per share. So let's say if the pool of funds is of 100 crores and you have to pay, let's say 3 crores as an expense to fund manager and all the employees of the company, all those expenses to be paid. So 97 crores is the amount left, and these 97 crores will be divided among, let's say, 10 crore people who have invested in these funds, or 10 crore units which has been invested in the fund. So 9.7 rupees would be the NAV per share of the fund. Basically, to keep it simple, I would say it is the current market price at the fund at which the fund is traded. Basically, value per unit on a specific day. That is also a correct definition, Ashish. NAV per unit and NAV per share is same. So yeah, NAV per unit. Shares are used in case of equity stocks. NAV per unit in case of mutual funds. Perfect. Here, open-ended funds will have variable number of units. Close-ended funds will have a fixed number of units. Yes, I am coming to that slide. Please note down the formula once I'm there. Total assets minus total outstanding liabilities divided by number of units. Now, these number of units that is been mentioned over here is variable for an open-ended fund. But these number of units are fixed for close-ended funds. Anyone able to get why? Because in an open-ended fund, the counter is open or the counter is closed. The counter is open. So there would be people who would want to redeem their shares. So fund have to buy shares and sell shares. By shares, I mean units. Fund has to buy units and sell units. If you are going to buy units, NAV number of units will increase. If you are going to sell units, number of units will fall. So the number of units with the fund will be variable. On the other hand, in a close-ended fund, the counter is closed, right? So once the fund has issued and it has been closed on a date, let's say the fund closed on 15 July. After 15 July, it will be traded among the investors. He will buy from him, he will buy from him, he will buy from him, and it will be traded among the investors. The fund has nothing to do with this. So once the number of units are issued, it will be traded among investors. The fund has fixed number of units that was issued at the time of the launch. And that launch is new fund offer. There might be many examples, like if you Google, you will find many close-ended funds, SBI close-ended funds, uh, ICICI close-ended funds. Yes, like IPOSK. You are correct. So then for the names and examples, specific names, you can try to search for them. Honestly, I am unaware about the names, to be very honest. Although in any of the exams, no one is going to ask you about the specific names. Lock-in period. Do you think open-ended funds would have lock-in period? The counter is always open. So you can buy or sell anytime. So no lock-in period. But in case of close-ended funds, there might be a lock-in period. Yes, they have entry loads and exit loads. Yeah. Although open-ended funds don't have a lock-in period, there is something called as exit loads. What is exit loads? Let's say that you invested in the fund today. You invested in the fund today. They are high. They are more volatile than obviously the close-ended funds. But you will get to know why the volatility is minimized with the help of exit loads. So just be with me, RK. I'll try to explain this to you. What are exit loads? Basically, let's say you bought the units of the open-ended fund on 1st Jan for 22 rupees per share, 22 rupees per unit. And on 31st Jan, you wish to exit the fund and the price is 24 rupees per unit. Although you can sell the fund, although you can sell the fund, but there might be a provision of exit load. It means that if NAV is 24 rupees, you will get 10% discount or 15% discount or 5% discount with to NAV. So if although the fund NAV is 24 rupees, it will be given to you at 22 rupees. Why? Because simply because you are entering and exiting the funds very quickly, and due to which the investment manager has to invest and redeem the funds or the underlying assets that funds invest in very quickly. So that is why open-ended funds prevent investor that comes in between. That ELSS is basically something which shares some criteria of equity, open-ended funds as well as closed-ended funds. We will see what ELSS is. Okay, moving on. So yeah, although everything has been summarized in, I think handwriting is legible. So I will share this sheet with you and you will be able to see this. So the lock-in period, in case of lock-in period, the open-ended schemes does not have a lock-in period, but they have loads, entry loads and exit loads. Yes. The last example, basically, since you are investing and redeeming your units very quickly, open-ended funds may prevent you from doing so by introducing exit loads. What are basically exit loads? Exit loads, if the fund rate is 24 rupees, you will get only 22 rupees per unit. Why? Because you are creating trouble for the asset manager by investing and redeeming the shares very quickly. Similarly, there can be entry load as well. Now, what will be the entry load? If the fund price is 22 rupees, you need to invest 24 rupees to invest in that fund. Through this, open-ended funds and close open-ended funds try to prevent volatility. Volatility in terms of number of units. Okay. Everyone, Shivani, are you clear with this? Exit loads and entry loads, both. IPO, also that is something which is introduced in cash equities. What is the difference between IPO and FPO? But still, if you are curious, I'll answer you. That IPO is initial public offering. So K entry load is introduced just because not everyone take open-ended funds for granted using trading purpose. So you are buying and selling open-ended funds. At least you should sell in profit. That is why loads are being introduced. Yes, loads are in open-ended funds only. For close-ended funds, once the market or once the mutual fund house has sold the fund, they have nothing to do with the investors, right? So how they can be introduced to uh, loads, exit loads or entry loads. Now, what is IPO? IPO is initial public offering. FPO is follow-on public offer. What is the difference between them? IPO is basically introduced for the first time. If the first time a company is coming up for launching its shares, it has to come up with an IPO. For FPO. Once the already listed company in the market wants to list more shares in the market, they will come up with a FPO. Recently, Vodafone Idea came up with an FPO. That is RK dependent on, differs from fund to fund. For few funds, it would be 6 months. For few funds, it would be 1 year or 9 months. FPO is follow on public offer. Okay. So do you guys need break for 5 minutes so that we can be right back? Okay. Take a 5 minute break, but be right back on time. Make sure that you are back on time. That is a type of asset management or investment avenue. If we see, it is related to premiums like insurances. So ULIP is like, although we will cover ULIP as well, Priyanka, we will come to ULIP as well. FPO are follow on public offer. A already listed company with an IPO wants to raise shares again. In that case, they will come up with an FPO, follow on public offer. Yes, you can invest. You can invest 1,000 rupees in mutual funds as well. Will we learn best strategies in investment trading and doing options? No, options trading is not covered in this course. No, sir. And options trading is not covered in this course. Hybrid fund is basically a fund which invests in equity and debt both. So we have just covered uh, open-ended and close-ended part. Now, interval funds who are generally open-ended funds, who are generally close-ended funds, but open their shutters in between. Yes, yes, we will be completing this module by today. Investment strategies, as in we are into fundamental analysis. So we will be seeing that how to evaluate a company based on what a company is a right decision for us to be invested in. So those factors we will cover. Index funds is a different criteria. Index funds cannot be categorized under open-ended or close-ended funds. As you can see over here, open-ended, close-ended funds are classification by structure, and index funds comes under other schemes. That is great. That is great. Lenovo. Yes, yes, I just forget your name. Please rename that part, yeah. Please, sincere request. I'm sorry, Aryan, but we are not allowed to share. In case you have doubts, you can raise a ticket about it. What is transparency in mutual funds? Okay, guys, I'll take your doubts. Just give me some time. Just give me some time. Let the others join as well. In a couple of minutes, we will start. Let me take a sip of water and I'll be right back. Okay, guys, so let's start. Let's start. Now, by structure, we covered open-ended funds and close-ended funds. What are interval funds? Interval funds are generally close-ended funds, but open their shutters in between. They act as an open-ended funds. They at certain intervals, they act as an open-ended funds, and in general, they are close-ended funds. These are interval funds. So open-ended plus close-ended would be interval funds, which acts as an open-ended funds in certain intervals. Now, coming to classification of mutual funds by nature, there is equity funds. Now, what is Prachi? In what is interval fund? Interval funds are those funds Interval funds are those funds which are generally close-ended, which have generally closed their counters, but acts as an open-ended funds in between. So let's say their close-ended funds is with 5 year of maturity. So for the first 3 years, they can act as a closed-ended fund. From year 3 year to 4 year, they will be an open-ended fund. And from fourth to fifth, they will again be closed-ended funds. So in the interval between 3 to 4, they were open-ended funds. These are interval funds. Okay, perfect. Next, equity funds. Equity funds are those funds which invest their pool of funds in equity securities. Okay, debt funds are those funds that invest in debt securities, basically bonds and debentures. Balanced funds, balanced funds invest both in equity as well as in debt. Now, equity schemes or equity funds are also called growth schemes. Shares and securities are same thing. So as I said, this is the last class for 1 to 2 4. If you are from 1 to 2 3, sorry, 1 to 2 3 batch, then this is the last class for you. Okay. Growth schemes. Why? Because equity funds, why it is considered under mutual funds? Because mutual funds create a pool of funds, that is mutual fund. Mutual, this pool belongs to mutually belong to other people. What are mutual friends? Friends to you and friends to everyone else or someone else. There is, in the same way, mutual funds are those funds that belongs to you as well as some other people. So that is why these funds are collected once and then invested in equity securities. Okay. Yes, DS, you are correct. This is the last class. Okay. Then equity funds are also called as growth schemes. Why? Equity funds are also called as growth schemes. Why? Because in equity schemes are equity compared to fixed income, we studied, has higher risk as well as higher reward. So one who invests in equity wants to grow their capital. That is why it is called a growth scheme. Equity schemes are called growth schemes. On the other hand, debt funds provide interest income, periodic interest income. So it is a source of income for you if you invest in debt funds. So that is called income schemes. Now, please evaluate carefully. If a person who is a working professional would wish to invest in growth schemes, yeah, other than equity, they may invest in other asset classes like gold or alternative assets as well. Objectives. Oh, where was I? Sorry. Yeah, a person who is a working professional would be investing in growth schemes because he want to grow his capital. A person, on the other hand, who is retired and wants a stable source of income would invest in income schemes. That is fixed income schemes. That is debt fund. Okay. Then there is balanced fund, which provides you a stable income as well as capital appreciation. Then there are money market schemes. which is again, as you guys remember, money market schemes are for ultra short term, less than 1 year. These funds invest in those securities that are for ultra short term and less than 1 year. Other schemes are tax saving schemes. I will cover ELSS separately. Index funds and sector specific funds. Let me cover index funds and specific sector specific funds first. Index funds are basically those funds that try to replicate the performance of, yes, it is part of mutual fund. Index funds are those funds that try to replicate the performance of an index like Nifty or Nasdaq. So what index fund managers would do, they would simply collect funds from the investors, create a pool of funds, and invest in all the security present in a given index. So if Nifty has 50 securities, they will invest in those 50 securities. Okay. Now, what is sector specific funds? Let's suppose you have 10,000 rupees. Nasdaq is basically a index of IT stocks in US. US IT stocks, like there is Nifty in India, it's Nasdaq in US. 10,000 rupees. Okay, where was I? Yeah, let's suppose you have 10,000 rupees and you want to invest in all the companies related to shoe wear industry or footwear industry, sorry. So, or let's say IT industry or IT sector. So what you could do, you can buy a sector specific funds which invests in IT sector in 10,000 rupees only. You will get exposure to the majority of IT companies that is been trading in the market. If you want to invest in finance industry, you can invest in sector specific fund related to finance industry. Probably they may be replicating Fin Nifty, that is finance Nifty, as their security index. And based on that, they might be generating returns. So these are sector specific funds. Now, yeah, that is also an important point. Index funds will basically, I will ask you this question. Like when you will invest in an index fund, does fund manager has to work on selection of securities, or he will be just selecting securities out of the already made index? Does the fund manager has to spend his time selecting the securities when you will be investing in an index fund? No, because he is investing in an already made index. Correct, Ashish. So the Nifty is already made. Nifty already does exist in the market in the right proportion. What he wants to do is just enlist all the stocks in Nifty don't have to research about it and invest in the stocks that Nifty has. That is why the fund managers will have lower fees, and that would result in lower transaction cost for the investors. Another reason is replicating index funds. Replicating index funds means investing in the securities of the index, and the securities of the index does not change every now and then. Securities of the index or constituents of the index in a professional manner does not change every now and then. So basically, so basically, the fund manager won't be involved in actively buying and selling securities. These funds are passively managed, and based on that, the transaction fees is less. Index funds, there is no compulsion that index funds will replicate large cap companies. If based on market cap, you have invested in an index fund which covers Nifty mid cap. So it will reflect mid cap companies. If it covers Nifty small cap, then it will reflect Nifty small cap companies. Now, what is this mid cap, small cap, and large cap? So based on market capitalization, what is market capitalization? Number of shares multiplied by price per share. Based on market capitalization, it means that if you want to buy all the equity shares of a company, what is the amount that you need to pay? That is market capitalization. Based on market capitalization, what is the size of your firm? If it is a large cap company, it is one of the largest companies in terms of market cap. Can anyone Google and tell me the limit or the threshold limit of large cap companies in India, even mid cap companies in India, and small cap companies in India? Can anyone help me out with the numbers? More than 1,25,000 crores is large cap. Okay. So is this number not correct? Large cap more than 20,000 crores. Okay. Large cap is more than 20,000 crores. Perfect. This seems correct. Mid cap more than 10,000, and small cap is less than 5,000. Okay. Less than 5,000 crores. Less than 20,000 and more than 5,000 will be your mid cap shares. Correct. So if you are investing in a large cap index, it will track large cap securities, mid cap index, mid cap securities, and small cap index, small cap securities. Now, if you are able to invest for a longer period of time, it means that you have more risk appetite. If you are able to invest in a longer period of time, for a longer period of time, it means that you have a more risk appetite. So, which among these three market cap companies do you feel is the highest risky ones? And which is the least risky one? The small cap companies comes with the highest risk and large cap companies comes with the lowest risk. So if your time horizon of investment is less, you need to go for large cap companies. On the other hand, if you have a longer time horizon to keep your capital invested in the market, you can go for a company with small cap, which is of higher risk. Everyone clear with this? Everyone clear with this? Yes, small cap is easy to manipulate as it has low market cap. Small cap carry less amount, then it should have less risk, right? No, actually, if there is a company with, let's say, 10 crore of market cap, then few big players having 2 crores, a company with 10 crore market cap, each of us decide to invest 1 lakh rupees, and there are 100 people in this class, and so the 1 crore would be the corpus, and we can buy the shares of the company that is small cap and make its prices rise. Similarly, we can make the prices fall as well. So this makes small cap companies highly risky. So there is a portal SK which is called mutualfundsahihai.com, in which you can track the performance of a mutual fund. Okay, now coming to ELSS. Shivani is saying that if small cap has less funds, ETFs are different. Exchange traded ETFs are listed on a stock exchange. Index funds are not listed generally on a stock exchange. You can buy or sell ETFs like common shares, but index funds are somewhat different to ETFs. Some index funds is launched by a mutual fund. ETFs are a listed entity on stock exchange. Rupee Invest is also a best website for mutual fund evaluation. That is what Priyanka is saying. Okay, Shivani is here with a doubt. She feels that small cap companies, small cap companies have less market cap. Long-term investment in small cap, short-term investment in large cap. Correct. Small cap companies has less market cap, so it should be less risky. If I ask you, Shivani, what is risk? Risk is nothing but volatility or change in price. How fast a stock moves upwards or downwards is basically the risk of the stock. Am I correct, Shivani? Shivani, am I correct? So how fast a stock moves upwards or downwards, that is basically a risk of a stock. Let's suppose if 100 of us come together and decide that I want to move Reliance by 1%. Will we be able to do that? There are around 100 people in the class, and if all of us come together and decide that if we want to move Reliance with 1%, can we be able to do that? The answer is no. But on the other end, if there is a security with only 10 crore of market cap, it means that if all of us buy those shares based on our wealth, all the shares in the market will be sucked up by us and it would be in upper circuit. So don't you think the shares which have small cap will have higher volatility as compared to a share with a large cap? Because many players coming together cannot also move a large cap share. But a stock which is small cap can be moved by just few individuals, which makes it highly risky. Are you clear with this now, Shivani? Coming to ELSS, equity linked saving schemes. Now, equity linked saving schemes is like a mutual fund, but differs from a mutual fund in few manners. And the one of the prime reason is tax benefit. The gains on ELSS, that is equity linked saving schemes, is tax exempted. What I mean by tax exempted, you don't have to pay tax on it, on the returns generated on it. And you can claim tax deductions as well. But equity linked saving schemes, why it is tax exempted? To understand that, you need to analyze when people are investing in ELSS, people are investing in equity market of India or a particular nation. Government would want more and more people to invest in equity market. But when, which government would prefer which type of people? The one, so ATC, yes, ATC is the deduction to which tax exempted only if held till 3 years. Yes, after 3 years, you can redeem ELSS. It is ELSS comes with a lock-in period. You can't actually redeem ELSS before 3 years, as far as I know. Please correct me if I am wrong about it. Taxes and other than equity investment, these pooled products is something that I have a very less exposure of. But as far as I remember, I know, as far as I have studied during my exams on mutual funds, ELSS are locked in for 3 years, and only after 3 years it could be redeemed. So you cannot withdraw mutual ELSS before 3 years. Equity government would want people to invest in equity market, but would they want stable investors, or would they want investors who are buying today and selling tomorrow? What would they want? Who would they prefer more? Would they prefer more the stable investors or those investors who will be buying today and selling tomorrow? They would be preferring stable investors, because a stable investor to the economy will give you fund for a better period of time to generate a better return. Now, since ELSS is with a lock-in period, ELSS is with a lock-in period of 3 years, government exempt tax on ELSS. Government give tax exemptions to ELSS under section 80C. While other mutual fund gains, other gains on mutual funds are tax deductible. Now, coming on to the next part. What is ULIPs? Unit linked. So Ashish is saying chapter 6A of Income Tax Act. That is something that a chartered accountant needs to cover. We are financial analysts. So, although thanks for the information, Chapter 6 of the 6A of the Income Tax Act allows the deductions of ELSS under Section 80D, 80C. Correct, Ashish? What returns can we expect from ELSS? The returns that a prime equity market gives, what the index gives or equity market of the country gives, that returns can be expected from ELSS. Okay. Okay, Soumya. Unit linked insurance plans. Now, when you invest in insurance, let's say a mediclaim. What is a mediclaim? Basically, a health insurance. You protect yourself from uncertainty. Correct? And when I say uncertainty, I mean financial uncertainty. So if there is a person who have taken a mediclaim for the year 2023-24, would he wish that he gets admitted to a hospital to claim this medical insurance? Would he wish that? Would any logical person wish that? The answer is no, right? On the other hand, if you invest in an insurance, let's say a health insurance or a life insurance, it is subject to contingency. If that contingent event occurs, then you will get the claim. And if that contingent event does not occur, that insurance will be lapsed at the end of maturity and you will have to renew it. Correct? Correct, everyone? Do you guys agree with me till here? So there has always been a problem with insurance that the money that you spend on insurance does not provide you with returns. And rightly so, because insurance are not investments. Investments are for income and growth. Insurance is protection from uncertainty. Agreed, everyone? Insurance are basically protection from uncertainty. So there is something called as ULIPs, unit linked insurance plans, which collects your insurance premium or the amount you have invested as premiums. Invest that amount in the capital markets and also provide you with the returns generated through that amount, along with an insured amount in case of a contingency. Basically, what are ULIPs? ULIPs are simply insurance with an investment benefit or investment with an insurance benefit. So these are ULIPs, where you also boost your returns yes, You are also getting a life cover. You are getting growth on your capital. And with that, you are also having tax savings again under the section 80C. Am I correct, Ashish? Is ULIP subject to tax deductions? It should be, because it is insurance, and it is a type of insurance, and insurance is for protecting ourselves. Insurance premium should be categorized as an expense. Yes, that completely depends on you, whether you should go for a ULIP or a term insurance. The premium for ULIP is better. Sorry, the premium for ULIP is greater. The premium for term insurance is lower. But with ULIP, you also get return. Under term insurance, the return is only guaranteed under the contingent event in case of a contingency. So guys, clear what is ULIP? Coming to the next part, that is coming to the next part, that is pension funds. Now, what are pension funds? Pension funds are broadly classified into two types. One, defined benefit obligation. Defined benefit obligation plan. And second one is defined contribution plan. Take a moment and try to analyze what does these two words mean. Defined benefit obligation plan, where the benefit is defined, and defined contribution plan, where the contribution is defined. Take a moment and let me know about your thoughts on this. Correct. Yes, GA, you are correct. Defined contribution is what we contribute. We as in the employer. In benefit, your company contributes. And in contribution, employee contributes. No, this is wrong. No, yeah, employee also contributes to defined contribution plan, and even the company contributes to the defined contribution plan. Both contribute. No worries, KK. Both employer and employee contributes, okay. But what makes a defined benefit obligation plan, and let's remove the word obligation for now. Defined benefit plan differ. What makes defined benefit plan differ from defined contribution plan? In a defined benefit plan, the word itself says the benefit is defined. The benefit is defined. It means that on the employment contract itself, I am giving you the commitment as an employer that you will be paid, you will be paid 40% of your last drawn salary every month till your death. This is this is defined benefit plan, where the benefit is already defined. Now, the question is, when will the employer make investments to provide this benefit? When will the employer make investments to provide this benefit? Because why I wrote their defined benefit obligation plan, because this benefit is the liability for an employer, the future obligation for the employer that he will have to serve, because he has committed that he is going to give 40% of the last drawn salary. Any profession, example of any profession where this is widely accepted? Defense, Army, Navy, Air Force. Where the employer gives the pension guarantee, that is government of India gives the pension guarantee. There were in India as well various other sectors in government, all government sectors employees used to get pension, but now it has declined. It has been limited to very few sectors in which they will be, government employees will be available for pensions. There may be other sectors as well, like I guess MP and MLAs also get pensions, if I am not wrong. MP and MLAs also get pensions. So this could be the other example. Now, the question is, you guys ignored my questions, guys. Please reply. When will the employer make investment to provide this benefit? Let's suppose there is a person who has joined army in 21 year of age. He has worked for army till the age of 50, and from 50 till forever, he is till his death. For 80, he is retired. So when would the employer should make the contribution? Don't you think that if employer, maybe a government institution or maybe a private institution, should invest in the retirement fund of this employee, which will be given to the employee over here, the government should keep on investing a small amount every month out of his salary from 21st of age to 50th of age, so that government can meet the retirement requirements of this fund. The fund or the amount needed for the retirement, don't you think so? Government should keep on making some small contributions over these period of time. Here, the benefit is defined. Now the question is, what is the amount of fund that will be required? Who knows that? Who knows that for how many years, for how many years is this person, is this army man going to last after his retirement? for how many years the employee is going to be alive after his retirement, because for those many months the government will have to serve the pension. So there is a different field of finance and statistics which is named as actuarial science. Yes, after the death, 50% of the pension is provided to the spouse. So also need to evaluate for how many years the spouse will be able to be alive. So there is a field which is actuarial science that studies the statistics and try to find out these values. Basically, they try to get a prediction of these values. No one can come to an accurate value, but they try to get predictions of these values. Also, yes, correct. There is some, so there are 100 in insurance industry as well. This is a very in demand profession. Let's suppose there is an insurance company which provides healthcare and mediclaim insurance. So this is a health insurance. This health insurance is being sold to 500 people. Now, what should be the premiums that should be charged with all these 500 people so that they can also be able to provide the claims from these premiums collected, also be able to serve the claims from the premiums collected. With this, also be able to take out their own set of expenses, employee expenses and commissions, and also run a profitable business. For that, what is the amount the premium should be collected? These premiums are decided based on actuarial assumptions. And these actuarial assumptions are made by actuarial scientists. Whether you may be from a science, arts, I don't know actually, but I think you need to be from 12th science to pursue actuarial science in India. In 12th standard, you need to be from science background. Can anyone check and tell me and confirm me that what is the background that actuarial science as a profession demands? I guess there are 16 papers in actuarial science. Yes, it is not necessary, but someone is asking. So this is, I think, addresses concern. I think there is 16 papers in actuarial science. And if you want to pursue actuarial science as a profession, 12th science, commerce ones are also doing. Okay. AI is saying, so I have got two contradictory answers. GA is saying one from commerce are also doing, probably they had taken science till 12th. And then they have come, and also maths is compulsion. So even if you have taken science, you should have taken maths as well along with science to be an actuarial scientist. Now, this is how after 2-3 crore package, I am not sure about it. 2-3 papers, 1 crore of package. I am not sure about it, about the package scenario. But yeah, it is one of the highest paying profession around the world. Defined benefit plan. The final one is defined contribution plan. One important thing about the defined benefit plan that we missed to discuss, let's say the contributions made by the employer in the retirement fund during the retirement, at the time of retirement, is not able to fund the retirement, then what employer will do? Employer will make more contribution. So basically, the return, the investment risk in case of defined benefit plan or defined benefit obligation is taken by employer. So if he is not able to generate the expected return, he will have to contribute more in a defined benefit plan. On the other hand, in case of a defined contribution plan, contribution by employer is fixed. So let's suppose you need to invest 20,000 in your PF account. 20,000 every month needs to be invested in your PF account. So basically, you will invest 10,000 and your employer will invest 10,000. Whether this 20,000 once invested, this 10,000 once invested by employer, he has completed his share of the obligation. He has completed his share of promise. Then he has nothing to do whether this 20,000 generates 10% return, 20% return, or 50% return. The investment risk will be assumed by employees. And that is the characteristic of a defined contribution plan. Any doubt still here? Guys, any doubt still here? So that was all it for the day, guys. Thanks a lot. A special thanks to the batch 1224, who all have the last lecture for today. I hope you have a great career ahead. I hope that you guys rock in whatever field you choose. Yes, Veera, please tell me. What is fund of funds? Okay. So basically, there are hedge funds. There are many investors who invest in. There are individual investors. Yes, 1, 2, 2, 3 is only. I am talking about 1, 2, 2, 3 only, not 1, 2, 2, 4. Just I'll give you the greetings, guys. Just wait a minute. Karan is asking about fund of funds. Let me highlight him what is fund of funds. Let's say 100 million, 100 million, 100 million, and 100 million is contributed by investors to an organization called fund of funds. Now, what fund of funds will do? Fund of funds will invest this in different hedge funds. Hedge funds 1, hedge fund 2, hedge fund 3, hedge fund 4, and then this hedge fund will invest it in the different companies and different securities. Benefit of fund of fund, greater diversification. Drawback of fund is double layered fees. Although this was not covered in curriculum in the notes as well, but still. Double layered fees because you will have to provide fees to fund managers as well of hedge funds, as well as the fund of fund manager as well. So there might be a section which says ask a doubt. From there you can raise a ticket, Prachi. Fund of funds or investment funds amount in other mutual funds. Yeah, that can also be the case. Instead of hedge fund, they could also invest in mutual funds as well. After completing this course, yes, at the time as your LMS is active, raise a ticket. I will be there to solve it out. So that was all from my side, guys. Let me just share the PDF part. in the chat box. The topic was asset management and mutual funds. I'm dropping. Next class, we will be starting with, I guess, cash equities. Okay. So thank you guys. Thanks a lot. All the best to the batch from 1 to 24. Thank you guys. Really, it was wonderful interacting with you. See the rest of you next week. All the best for your exams to the batch 1 to 23. Sorry, not 1 to 24, 1 to 23. Bye bye, guys. Have fun. Enjoy your day. Enjoy the rest of the week. See you guys again. Sure, TV, sure. If destiny have its faith. Again, for when will be the exams? Please raise a ticket. How to prepare for the exams? Basically, there are objective and subjective two types of exams. If you have been attentive in lecture, if you have made your own notes, the exam won't be more than a cakewalk for you. So you would clearly ace the exams if you have been attentive in lecture and you have made your own notes. So in your profile section, you might have a batch name. There you can see which batch are you from. No worries, case. Question will only be choose or someone other. Question will only be choose or someone other. I'm not getting this. Bye, guys. Bye, 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 bye. Yes, choose the correct answer would be there, and there would be a subjective exam as well, where you will have to type in the answer. So around August, mid of August, and by the end of August, probably. Abhijit. Take care. Bye. Thank you. Thanks a lot, guys. Bye bye. Have fun. All the best.